Welcome, everyone. It's Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. Today's podcast is titled Famed Economist Larry McDonald, Investing Through Turbulence Across All Asset Classes. It features, of course, the before mentioned, and I've known Larry for many years, Larry McDonald, economist and publisher of the incredible The Bear Trap Report. Larry, why don't I start being friendly for a change? Welcome to the show.
How are you, my friend? I missed the days when we hosted our book party up in Greenwich, Connecticut.
That would be, by the way, the lovely inn, Thomas Hankelman's at the Homestead Inn in Greenwich, Connecticut.
Yeah.
Amazing setting with a fireplace. Yeah, that does take us back to your a little bit back in the day. So why don't I get to it? I mean, we're in early mid-February. There's lots going on, and on the surface, it doesn't necessarily look so bad. So let me set the stage for everyone. And some of this is a courtesy of my good friend who will be coming up on the show as well, the investor Tal Schwartz. So a little bit of a shout out to him. But let's take a look at some things going on. We have an enormous fiscal stimulus underway with Biden. Likely also a massive multi-trillion-dollar infrastructure plan. The economy looks ripe for expansion. S&P fourth quarter earnings were surprisingly good. The Federal Reserve has pledged to keep interest rates near zero for months or even through the year. There is a continuing decline in new COVID-19 cases. Vaccine availability is accelerating perhaps a little quicker than we first thought. Like, this is a bull market's dream scenario. That could lead to a once-in-a-lifetime rally. Now, none of us have a crystal ball. Maybe that is going to be the case short term. But why would, after giving you that rosy picture, Larry, why should we perhaps still be concerned? Or maybe not?
Well, there's certain parts of the market that are just have priced in a lot of goodwill. And we saw this in 2016, 17, when the Trump administration came in. There was supposed to be an infrastructure plan, and copper names were up 100%. Small caps had an enormous rally because historically, when fiscal spending comes into markets, capital flows into steepeners. In other words, think of 2s 30s in treasuries or 2s 10s. So typically when you have a big capital infusion of fiscal spending, the curve steepens. So in other words, the front end comes down, the long end goes higher in yields. And when that happens, you typically have a rotation into things like small caps. And if you look at the small caps, the Russell 2000, the average, say the top 10 stocks in terms of performance in the Russell 2000, the best stock's up 750% this year. The worst of the top 10 is up 450. So you're talking about just an enormous amount of goodwill that's already been priced into small caps, for example. There's other parts of the market that are pretty cheap when it comes, which we can get into. But this small cap thing is setting up for if there's a hiccup with the fiscal. In other words, if Washington stumbles as they did remember 2016, 17, the Republicans made a catastrophic mistake. They put healthcare in front of infrastructure that slowed the whole thing down. We didn't get the tax cuts, the fiscal plan that we were supposed to get in May, June, July 2017. We ended up getting that in almost late November, early December. And so the market literally priced in reflation. The reflation trades completely collapsed by June, July, August, and then by the fourth quarter 2017, reflation trades were back priced in. So oftentimes when it comes to fiscal policy, Angelo, you have two trades. You have the first trade, which prices in almost 90% of the juice, and then a little bit of an adjustment period, and then the real trade.
Interesting. So yes, I mean, it does appear in the public markets. It's very heavily concentrated. Mainly some of the FANG and some of the tech companies, Tesla, et cetera, have done incredibly well. Even when sometimes you would look at it and say, if thinking as a value investor, maybe the math doesn't make sense. We're going to get a little bit to some of that later because I think it is complicated and not as easy as just looking at what we used to look at simply for metrics that we look at in the market. So you believe that there is a bit, I guess, of irrational exuberance in the market, even though I gave you some positive signs that do appear to be positive. You think that we could be in for a topsy-turvy, a real hardcore up and down year? Is that what you're saying?
Well, I'm saying there's still some pockets of real value in the commodity space. I mean, I want to be very clear. When it comes to commodities, you're talking about a 10-year bear market. And it's a little bit like the credit markets in March, April, May. What happened in March, April, May, June when credit markets, triple C's were unloved from March, April, May, June. All of a sudden, July, August, September, this quarter, now triple C's are really ripping onto the tights. In other words, what happens is when you go into a bull market situation, oftentimes in the early stages of a bull market, the tertiary parts of commodities, for example, are still extremely cheap. So uranium names, coal names, and they're coming out of 10-year bear markets. And so we see, in some of these parts of the commodity space, it's similar to what we were talking about with the credit markets. You just have a commodity boom that's in early stages, whereas some parts of the commodity space have been left behind and they will catch up. And so companies like Arch Coal, BTU, remember, infrastructure, when we do get it, is going to require a lot of green buildings. And those buildings are actually built with steel, and that steel comes from met coal. So these coal names that focus on met coal, Tech Resources, Arch Coal, BTU, these companies that are in the met coal space, they have tremendous upside from here. And not only that, green windmills. The amount of steel that goes into these windmill portfolios is just mind-boggling. So there's a lot of trades that have been left behind, and there's a lot of trades on the green side that have priced in way too much goodwill.
Interesting. And certainly commodities is going to be a good part of our dialogue. And I agree with you on multiple different fronts. It has been a terrible market for much of the last 10 years from that. But, cycles, things change based on conditions. And we're certainly in unique times now. And certainly, as noted, with the likely infrastructure, at least here in the US, bill passing and all that, that is going to be good for certain commodities. Right now, and I guess I'm getting right to a key question before I get to some of the buildup of it. So I'm reversing things a little bit today. It's good to mix things up. How should I be investing across, quote unquote, all asset classes? I mean, what does the average family office maybe has 3 to 5% exposures to commodities? I mean, I've had on you, Mark Faber, and others that are like, that's ridiculous. That's way too low. What are some ways that they could be more active in their asset allocation, perhaps specific to commodities? And should they be investing more passively or more actively?
Well, you and I talked about this in July. So the trade is getting a little bit, it's not long on the tooth, but it's been maturing. But in July, I think it was in June, July, you and I talked about, at that point in time, you're talking about 110 trillion of bonds that were below 1.75%, 1.5%, 110 trillion of bonds that on the planet Earth that were below 1.75%. So that number in 2018, in the fourth quarter, as yields were higher, that number was less than 25 trillion. So you're talking about an extra $70 trillion that has come into fixed income at very, very nosebleed levels. So what that's done is it's basically forced, in my mind, the traditional 60-40 portfolio has to change to, I would say, more 60-20-20. I think you need to have 15, 20% of your portfolio in commodity producing equities. Remember, income producing equities in the commodity space. And there's a lot of income coming out of the commodity space. And so you need to have that as a larger portion of the portfolio going forward. The previous decade was a decade about deflation, was a decade about Brexits, trade wars, COVIDs, austerity. Those forces push capital into the United States and into companies that really benefit from deflation, and that's tech stocks. The next decade is going to be much more about not financial assets, but real hard assets. And so we're looking at an MMT decade where governments are funding fiscal policy with monetary policy, and those types of things. When you're using a greater combination of trillions and more dollars that are in fiscal and monetary together, you're naturally going to get a higher inflation narrative. And with the amount of money that's in bonds earning nothing, it's going to force, I think, probably $2 trillion of capital is going to leave the tech stocks of the world and move into not just commodities, but commodity equities. One of the best ETFs for our viewers right now is the EWU ETF. It says the United Kingdom, but it's really a portfolio of global companies that are exposed to the commodity space and financials. So you get a steeper yield curve, better for the financials. So the EWU ETF, you want to be lightening up on the NASDAQ and the S&P and putting capital into ETFs like the EWU, which is essentially a basket of big name commodity companies that are globally exposed, telecom companies and companies in the financial space.
So, I mean, we'll dive a little bit into oil and gold a little bit later, but basically, like I said, and that probably applies to institutional investors, relatively for the most part, their exposure to commodities is relatively low. I mentioned from my surveys with family offices 3 to 5%, but sometimes that was effectively near zero, and sometimes it was 15 or 20, but on average. So you're recommending to bring that up, including through equity exposure. Let's jump around to some other asset classes. So probably among the most. Yes, Larry.
I just want to make one thing clear.
Sure.
The one problem with what the financial nomenclature and the newspapers, it's really oftentimes when people say commodity exposure, they're just talking about long positions in gold or the GLD or silver. That's true. But yeah, you're right. You just want to emphasize when I say 15 to 20, commodity equities often don't get counted as commodity exposure, and that's wrong. And it should. So when I'm talking about 15, 20%, I'm talking about you want to be more globally exposed to Glencore, for example. If you have Glencore in a portfolio or Rio Tinto, for example, does that count as commodities? It should, but it probably doesn't in a lot of these asset allocation portfolio models. So that's one thing that people have to be cognizant of.
Well, since you brought it up earlier, how would people get exposure to, say, uranium and even more exclusive rare earths?
Well, we've done a ton of work on the uranium space, and we've been featured over the last couple of months in a couple of specials in the uranium space. But the URA ETF is a simple way to do it. URA, it's a Globex ETF. It's pretty well diversified. But there's really a massive fraud that's gone on in this green kind of renaissance. And it's just the amount of the transition, the fossil transition to the green nirvana, to the green meadow is much bigger than people think. And the media has downplayed it. And the amount of coal plants in India and China, right now, India's fastest growing fuel is diesel. You're talking about 1.4 billion people in India, 1.4 billion people in China. Both countries are addicted to fossil fuels. China gave 3 years ago a forecast of their oil imports. They're off by 1 million barrels a day. That's 365 million barrels of oil per year. They're just massively, it's a real fraud. I hate to say it. It's just a fraud that's been perpetrated on the developed markets of the world. And it's fine. Listen, these countries need to be part of the The transition away from fossil fuels isn't going to happen overnight. But the media has portrayed this as if it is, and the good, kind of the good feel to that green movement, and it's just not the case. Even Japan has just been way behind. They're massively addicted to coal and more gas and natural gas and oil. So uranium, the amount of nuclear power plants on the planet Earth over the next 20 years, we think it's going to be up close to 300%, especially with the smaller module facilities, which Bill Gates, Elon Musk, you have a huge lobby in Washington. And if you talk to people at the Department of Energy and the Biden administration, behind the scenes, there's a massive push toward a kind of a more realistic transition to that Green New Deal. And the nuclear element is just enormous. And in terms of importance, and we need really a fossil bridge, a nuclear bridge to the green meadow that's out there 10 years from now. And these uranium equities are coming out of a 10-year bear market. Their charts look delicious, and we think that there's just substantial upside here. Some of these names could be 500-600 baggers.
And relative to oil, I'll put it in a shocking format so it gets some attention. Do you think oil will hit $100 a barrel this year?
Yeah, there's two stories to oil. The 10-year, 5-year track for oil is trouble. Oil will be, the amount of diesel cars in India are expanding, but the amount of diesel cars in Europe was going to be zero in 5 years. So oil's in trouble naturally, but in the next 12 months, and you and I laid this out in the third and fourth quarter, but we've been pounding the table, energy bulls. We still are energy bulls. We have a Bloomberg chat with over 600 institutional investors, and there's 3 or 4 billionaires in there, very valuable contributors, friends of ours. And we have a gentleman who's a famous investor in the energy space, and he's been writing, we've been going back and forth. And one of the things that he's been talking about is just the CapEx destruction. People have no idea how much capital has been taken out of the energy space, and we saw this with shipping. The amount of capital to bring those ships back online can be extremely disruptive. So when you take 30% of the global shipping fleet offline and then try to bring it back, it's a problem, and it creates dislocations. The same type of thing has happened with oil. This whole election cycle, the Green New Deal, and just the whole crisis last year in the capital markets, that forced a tremendous amount of disinvestment in the oil patch. And when we have this snapback in demand that's going to be triggered by the vaccines, we think the world is going to be upwards of 4 million barrels a day undersupplied by the fourth quarter, and that gets you a 2008 type, $180 to $100 barrel of oil pretty easily. That doesn't mean it stays there for 10 years, but for a year from today, I think we're between $80 to $100 in Brent.
I completely agree. Not that matters to anyone, but oh well, share my opinion every now and then. Before we jump into some other asset classes, because my next question is going to be applicable to that, and among the economists and thought leaders I have on, it skews all over the place, but probably leans more towards inflation, from Jim Rickards and Dave Hunter and others that I've had on. Well, actually, Rickards may be a little bit of the opposite of that. But do you think, and who knows, 3, 5, 10 years out, we could take our guesses, but people are concerned over the next year, short term, deflation or inflation?
Well, the inflation camp has grown, right? The amount of people in our chat, our institutional Bloomberg chat, that are playing for inflation plays has grown. So I think short term, it's a little overcooked, but a year from today, we're going to have a real big problem, because the amount of fiscal spending that is being funded by central banks and the amount of the additional fiscal policy around the world is really hasn't even begun to impact asset prices as a whole. And rents are still collapsing in major cities. That's, as we saw yesterday, that's punishing CPI and suppressing CPI levels. owner's equivalent rent. It's a big part of the Fed's PCE. So you have these massive forces right now that are deflationary and massive forces that are inflationary. And so that's why inflation is been contained. But a year from today, as capital continues to flow in and chase for yield, and as we get that, like I said, we get the first fiscal plan, and then the second infrastructure plan. A year from today, we're going to have a real big inflation problem. So I think there's two ways to play this for the Fed. The Fed for the next 6 months, it's going to pound the table on a very accommodative posture. I think they're doing yield curve control behind the scenes. They haven't announced it formally, but they're definitely doing some type of yield curve control. Maybe they announce, if yields really start to pick up, they will announce this year some form of yield curve control. The fixed income clients in our Bloomberg chat, a number of them think that gets triggered at 1.5% on the 10-year. That triggers a formal yield curve control Fed announcement. And so the Fed's going to go, has a real black eye, two black eyes on the inequality front. So they have to pound the table on accommodation. And that pounding the table on accommodation feeds the fiscal beast. That means politicians around the world have a total different psychology around spending today than they did 10 years ago. And they really think the central banks have their back. So the spending is going to be higher, the monetary policy higher, and that gets you really runaway inflation about a year and a half. And that's when the Fed is going to have to abruptly, just like December 2018, Angelo, they lied to our faces. They promised us in that Fed meeting 2018. Oh yeah, I mean, but it was just the way they reversed policy, and the beast in the market broke the Fed over its knee. And they promised us in that meeting $50 billion a month of balance sheet expansion, and they promised us rate hikes. And 3 weeks later, they reversed the ship. And so that's what's probably going to happen about a year from today, after a year of pounding the table toward accommodation, inequality, fixes, and things like that. They'll have to do it. It'll be just a violent, abrupt reversal to try to contain inflation. And then that's when, about a year from now, is when you're going to have a real problem in the market.
Yeah, I mean, that means, I guess, to be tactical. It's not like maybe the prior 10 years, you could have been more passive and it probably played out for you pretty well. This is probably the time to be more tactical, more active, because that is going to matter, whether deflation or inflation. It's relatively basic economics. We all know in a deflationary environment, cash and T-bills, bonds, government bonds, absolutely, that could do well. But inflation will make that horrific, well, let me go into another question first. Most people that I have on kind of disagree with me on this, but I think inflation is so personal, especially for the super rich. And I give the example, they live in New York, they have second homes in the Hamptons in London. Try to be a little funny. They're buying art, they're buying sports teams. They're going to their kids to the best colleges. They're getting private health care. I'm sorry, but their inflation is not 2 or 3%. I bet you it's closer to 10 or 15%. Do you agree?
I agree. I mean, my wife and I and the kids have lived in New York for 15 years. And I've just seen the cost of education is up, just for private schools in New York is up almost 100%. And
yeah, I'm being conservative when I'm saying 10 or 15%.
Yeah, no, I think overall it's about 10 or 15, but there's some things are up 100 and, restaurant, now. So yeah, I know personally, granted, I wrote this New York Times bestseller about Lehman Brothers. It's now been published in 12 languages. It's one of the best-selling business books in the world. It's called The Colossal Failure of Common Sense. So I know a lot of ex-Lehman traders, Goldman, and all the different bankers. But I must know 200 people that have left the city the last 5 years for either just quality of life, the fact the cost of living. I mean, if you go from New York City to South Carolina, and you can, with taxes in Florida, you can drop your cost of living by like $200,000 or $300,000 a year. I mean, that's how crazy it can be. So
Yeah.
I agree with you 100% there.
Well, I'm glad someone finally does. Switching over a little bit to public equities, which probably still makes up the majority of many people's portfolios that are, don't maybe have a giant family business, et cetera. Yeah, for the prior 10 years, being more passive has probably played out pretty well. That world was rocked in the last year. And even the S&P has been heavily concentrated in FANG, Tesla, et cetera. And we all know this. Does it pay off to still be more tactical? I would assume so, but be diversified across sectors. What's your view of how that could play out in the public equities market? Or slightly changing that question, how should significant families and family offices, at least for the next year, likely be allocating to public equities?
Well, let's just go over this one more time. Think of the last decade. Brexit's, trade wars, austerity, tea parties, COVID. Those events drove, especially the trade war, drove trillions of dollars of assets into the United States, created an incredible, say 2018, 19, we had the most incredible deflation scares that we've ever had, really. And no, not ever, but probably since the Depression. And so that was before COVID. And so we had this decade that drove more and more and more capital into the United States. And the Fed was on this chest pounding kind of like normalized policy kind of philosophy. In other words, the Fed wasn't afraid to taper. The Fed wasn't afraid to increase rates. Now they've had this horrific kind of like black eye with inequality. So all these forces are now like a massive aircraft carrier that's turned the other way. And so the next 10 years, you want to be allocated globally. So you want to move out of US equities into equities that are more globally exposed. And that's why if you just look at the holdings of the EWU, that's a really wonderful portfolio for the next decade. And even though it's a UK ETF, those companies in the top 10 names are all just massive global great companies. And so that's really the shift is asset allocation with a more global view. I think right now through with the NASDAQ and with the IWM, small caps have gone up so much. The small caps have outperformed the S&P by close to 25-30% in the last 3 months. So those trades have really priced in a lot of goodwill. And so that's once again overcrowding in US equities. So and today we have a new high in the FXI, China. So I'm looking at Brazil, EWZ, Petrobras, Chile. We have an election this year, but major copper producers, commodity producing countries. We think that's where you're going to have the same type of multiple expansion that we saw in tech over the last 5 years. Software names go from 1 to 2 times sales to 20 to 30 times sales. That type of multiple expansion we're going to see on the global front, where people are going to have equities with commodities exposure, and that's where the flows are going to go.
It's a little off the beaten path question. I'll bring it up. I forgot the official name for it as it was formed, I believe, in 1989, but it's loosely known, partially jokingly, as the plunge protection team. Basically, that the US government doesn't want its stock market to tank. So a couple of strategic people, major government influencers, will do everything they could, I guess, including stimulus, obviously. But there are some people who feel even a little bit more behind the scenes nefarious things to kind of keep things looking good, money flowing into the market. How active do you think the so-called plunge protection team is to keep things afloat and looking good?
Well, very, very, very active last year for sure. And if you look at Japan, I mean, you've had this yield curve and a plunge protection team over there for a decade. We've had a very flat yield curve, but now we're in a reflationary environment. So you just look at the way the central banks have acted. One of the things that if you have that plunge protection team globally now, and the yield curve is steepening globally, I'm seeing a lot of clients buying, looking at swap spreads, looking at higher yields globally. And the best way to capitalize on that, which I left out of my last answer, but I want to follow that up, is Japanese banks are trading MUFG, Mitsubishi. The Japanese banks are trading at 0.6 times book. The US banks are trading at 1.3 times book. So it's the same dynamic where the last 10 years, capital flew into the United States and everybody wanted to be and had to be long US assets. To the Japan example, if we go into this global reflationary environment where bonds are at risk to some extent, one of the best hedges are Japanese banks, because if you do have a steepening yield curve globally, the MUFGs of the world, Mitsubishi, very large bank, globally diversified, but it's very decent concentration in Asia. That type of play where you have exposure to Japanese banks with the plunge protection team globally working in the US, Europe, and the United States, that's where you could get substantial outperformance.
Very, very interesting advice. Back a little bit to your comment about maybe American investors being more diversified in their public equity portfolios. And again, American stocks have done amazing, broadly speaking, over the last 10 years. But some of this is going to play into not just inflation, deflation, what's going on now, the world being rocked by COVID, et cetera, but the power or the strength of the dollar. Its demise has been called for a couple of years. What's going to be a viable alternative? I just don't see it.
Yeah, that's the problem is that the rest of the world, what happens in the United States is people look at the government, the irresponsible spending, the deficits, and they say, oh, geez, this is unsustainable. But what they don't do is, it's the same with politics. People don't look at people think like there's only one Donald Trump. In the last 5 years, there's like 20 Donald Trumps all around the planet Earth. You know what I mean? Like this guy Salvini in Italy that they finally have contained was literally just a carbon copy of Trump. So it's about understanding the Fed and understanding central banking and understanding that the US, although we're running very high deficits, the spending around the planet and the irresponsible nature of it is pretty remarkable. So net, I think there's the bigger story here. And you and I talked about this in July, August. And what I said on our program on this discussion was that the Fed has finally got the joke. And every time they tried to normalize policy in the post-Lehman era, every time the dollar strengthened so much, it crushed the global economy, what I call the global wrecking ball. And that fed back to the United States, and it created more and more inequality. It crushed manufacturing jobs in the Rust Belt. And essentially, I argue many times, Janet Yellen had a good chunk to do with why Donald Trump was put in office. It's those manufacturing jobs in the Rust Belt that were sent overseas by really a very, very strong dollar. And so that dynamic, the Fed has figured it out finally. And I'm convinced that the Fed, the ECB, the Bank of China, PBOC in China, they are containing the dollar because they know that as the dollar runs away in strength. So if the Fed were to announce a taper today, the dollar would run to 100. Global markets would crash if the dollar went back to 100 again. And so what's supporting the reflation trade, what's supporting global equities, what's supporting this global reflation, which that's what the world needs. We're coming out of the greatest deflation scare since the Depression. The Fed understands that they have to contain the dollar. So if you just look at any chart of the dollar, the Bloomberg dollar index, or the DXY, the dollar is failing consistently at the 100-day, and it looks very, very manipulated. So in other words, the Fed, the ECB, the central banks, they are not allowing the dollar to rally. So you will see counter trend rallies, especially like we had recently, like maybe 3-4 weeks ago, as those COVID variants started working their way through South Africa and into Brazil and through the United Kingdom. That type of problem is very, that's where you create a massive short covering rally in the dollar. I mean, so there's really two sides to the dollar story. One is the short interest is off the charts. People are short bonds, they're short the dollar. Everybody's looking for a dollar collapse. It's a very crowded trade. So you'll have these counter trend rallies that create buying opportunities in commodity equities. And so I think the Fed and the ECB and the Bank of Japan will continue to contain the dollar to help us come out of this COVID malaise for at least another year. Look for the dollar to fail at the 100-day. So every time the dollar gets to the fails at the 100-day, that's when you want to add to your commodity playbook. And it creates great buying opportunities. You look at the last week across our book, these commodity names were all down 10 to 15, in some cases 20%. And now in many cases, they've literally gone down 20% and they're back to even because the dollar has reversed. It's all dollar driven.
And back a little bit to public equities in an area that we may have some disagreement, but I want to learn. So again, FANG and Microsoft and Tesla have done amazing, broadly speaking, in the last year. It's just hard for me to imagine that Amazon, Facebook, Microsoft, who I mentioned, I mean, they're dominant companies unless there's an antitrust issue and they get broken up, Google, et cetera. Okay, they're probably not going to run away like they did in the last year, but I just can't see that they shouldn't be a part of someone's portfolio.
Well, okay, so Stan Druckenmiller has recently been talking about this. The problem is the net present value of cash flows. And a lot of people know this now. I talked about it on the program, so it's been getting out there. But tech stocks are essentially bonds. They're long-term cash flows, especially companies like Netflix. They reinvest all the money. In a deflationary environment, the net present value of those future cash flows is worth a lot more money. So they trade at much higher multiples. If we get a snapback in yields and inflation, tech stocks, I don't care how much the sales are growing, and they're just going to get crushed. They're really going to get crushed because so much money is in them, and they really haven't experienced an inflation shock. Number one. Number two, the perception, as you know, 9/11. I lived through 9/11. We had an apartment in the city in New York, and the perception was that nobody was going to go back to Manhattan, and this was like a deeply held suspicion or thesis that was in the real estate market. I know people that bought property in downtown Manhattan that had 5-6 baggers. He bought something for $1 million, went to $5 million 10 years later. I suspect that this COVID dynamic is similar, where it's going to crush, this urbanization trend that's been going on for like the last 20 years is now in reverse, which is driving all kinds of capital into tech stocks, because the tech stocks have almost oligopoly pricing power on the stay-at-home community, right? So that is very, very widely priced in. So I just think that as we get, and we're going to have antitrust movements in Washington this year, the Democrats and Republicans, even though Silicon Valley spends a ton of money in Washington, probably the biggest lobbyist, I still think you're going to have they're going to take one. They'll leave. They won't antitrust them all, but they'll have one victim. Probably the one company that didn't give the most to the lobby effort. But that's what's going to happen. So I just think net, you're better off outside of technology, especially just looking back through my life, all of our lives in investing. Whenever a sector gets up to, every single time, whether it be the banks in 2007 or the energy companies, whenever they get up near 30% of the S&P, it's just not a good place to be. You just don't want to be in an investment when 30% of the S&P, 36% is in tech. It's the components of the S&P 500. It's just not a great, it just never has been a great place to be the last 50, 60, 70 years. And I just think, maybe it's good for the next 6 months, but in the next 5 years, you never want to be in a sector that's that heavily a part of the S&P 500.
We're going to come back to one specific company in a minute, but setting a little bit of that stage and staying on topic, defining value investing. Really, aren't all investors value investors? They are buying today for the future of a company. Now, that does segue into my next question. And I say this with all due respect. I think you're great, but I think it's good to have some disagreement and a little bit of back and forth on the show. So here we go. I just wonder if people just don't get Tesla. it's just different. It's not just a car company that's a part of it. It's a climate change company. It's a big data company. It's a tech company by an extraordinary entrepreneur. We could argue maybe that plunge protection team, the US government, wants it to succeed, but the vision of what they're doing, and admittingly, he's been talking about robo-taxis for a while, and it does seem like it hasn't quite happened. But if you look at some of the deeper perspective of studying Tesla, people keep on calling for its demise, including short-term great investors like Michael Burry. A lot of people have been proven wrong the last year. That's no guarantee of the future. Why don't I stop there and get your feedback?
Well, it's similar to Amazon in '99. I mean, I heard the exact same argument about Amazon and Cisco, and they were right. In other words, Amazon's potential was incredible, and it's just what happened was you had a stock that priced in 10 years of goodwill into a very short period of time, and then eventually from 1999 to maybe 8 years later, it actually finally, after a 90% drawdown, it eventually got back to the old high and then went a lot higher. So in other words, I completely agree with you on Tesla. The Tesla type companies of the world, probably here's the story looking out the next 10 years. The company has an enterprise value close to 800 billion, right? 700 and some odd $billion enterprise value. So enterprise value is your equity and your debt. And so I see Tesla as being a, say, $750 billion company today. Within the next 2 years, it's probably going to get down to a $300 to $350 billion company. And then 5 to 10 years from now, it's probably going to be worth $3 or $4 or $5 trillion.
Okay, no, that actually, I think, absolutely that could happen. We don't have a crystal ball, we don't know, but even you understand the market dominance in certain areas longer term, that the visionary and still young and dynamic. Now things could change. He gets bored, he steps down, because I think he is one of those incredibly dynamic leaders. And definitely there are things that could happen, but it'll be interesting to watch how that plays out.
And I don't, maybe I said, I hope I said 3 trillion. No, in other words, you could go from 750 billion to 300 billion market cap to potentially 3 trillion if
for sure.
Everything. But what happens is with manias. Let me give you an example. I want you. So alternative energy versus conventional energy. Let me give you an example of what's happening right now. Sunrun, which is like one of these green, is trading at 173 times EBITDA. Enphase is trading at 82 times EBITDA. SolarEdge trading at 51 times EBITDA. And you're talking about Brookfield Renewable Properties trading at 25 times EBITDA. So what's happened is we've seen this over and over and over again. The birth of the internet, this great phenomenon, the birth of green new deals and green infrastructure spending. All this money comes in, 10 years of equity appreciation gets priced into a very short period of time. And then it takes to fill those shoes takes quite a while. Now here's the natural resource companies. Canadian Natural Resources, trading at 5.8 times EBITDA. ARC Resources, trading at 4 times EBITDA. So Parex Resources, trading at 3 times EBITDA. You got companies like Cameco, trading at 5 times EBITDA. So you've got companies like Cameco and Tesla is the perfect example. So you've got the largest uranium producer in the world. The biggest fraud facing all of us is the amount of electric vehicles that are being powered by coal plants. And so you have all this green technology, but it's a very mixed bag in terms of what's actual green. I just don't understand how like a massive green fleet of vehicles that's powered by coal plants is that green, because you're actually using more, you need more energy we're going to need, as Elon Musk has said himself, we're going to need at least a doubling of electricity production over the next 7 years to meet this electric vehicle demand. So where's that going to come from? Right now, 70% of the coal plants in China and India, 70% of the plants, electricity plants in China and India are coal. So the only way you get to where you want to be, so take your exact thesis on Tesla and all of the wonderful things that you just said. The only way you get there is with a tripling of the nuclear power plants on Earth. If not, the carbon footprint is going to explode.
Very good points. Let's buzz through a couple of other asset classes in terms of wealthy families or even institutional investors, but there is the tax difference and other perspectives that are different. And again, short term, whatever, the next 3 to 12 months. Part of this will depend on the earlier question I asked on inflation, deflation, but there are certainly families and institutions that want to have, more than 3 to 5% in cash. If nothing else, at least for families, it makes them sleep better at night. But understanding if inflation starts to rise, that could be a really, really bad bet. And I know you're not here to give specific investment advice. We're being very broad, educational, entertaining. What allocation in the short term do you think families should have to cash?
Well, with the move the market just made, you're much better off. As I talked about in my book, A Colossal Failure of Common Sense, you're much better off sitting in the boat with cash and waiting for drawdowns. We've had plenty of opportunities. Nobody wanted to buy stocks in the fourth quarter of 2018. Nobody wanted to buy stocks in March. And now everybody's jamming into stocks. So since Lehman, you're much better off sitting in the boat, waiting for opportunities. Don't chase. And that means you want to have at least, I think right now, at least 30% cash. And you want to be there for the drawdowns because we will get them. The problem is when stocks go on sale, nobody wants to buy them. So I just think after this move that we've had, you're just better off. You may miss another 5 or 10% on the upside, whatever it is, but if you'll be there to capitalize on real buying opportunities. And I think Buffett's in the same boat. Buffett's missed some of this rally, but he's sitting there with like 130 billion of cash, and he's starting to deploy it in the commodity space, but he's got a very large cash position.
Yes. Okay. So you're pretty much on board with probably the most famous economist I had on in the last month or so, and you would certainly join as my big two. And I disagree with that, but who am I to say? So 30% in cash. He also noted exactly that same number you said, and then 25%. So a grand total of 55% in cash and very short-term T-bills. And I admit, I guess in a deflationary environment, that could be good. But, maybe, and I'm not that young, but maybe I'm just more of an aggressive investor. That just seemed really, really high in something that is not getting you anything at the moment in real return.
Well, the way to offset that is we've had almost a depression in income-producing stocks like IBM. IBM, for example, right now, there's a lot of IBMs out there, but IBM equity yield, pulling it up here, there's so many, it's 5.3%. So you can own stocks like that. There's 100 IBMs out there that have this, incredible yields, a lot of them in the energy space. So you can have equity exposure, but I don't think you're going to get crushed in IBM over the next 10 years, and you're going to get 5% a year while you wait. And so, you want to find companies like that, companies that are, pretty much out of favor. Nobody wants to own value stocks, and nobody wants to own income-producing stocks. Everybody, that's what's happening in the market. The reason, one important thing, the reason the VIX is moving up with stocks, we're 27 this morning, the VIX 26, 27, is because it's the opposite of what's happening in March. In March, the VIX has always been called the fear index. The mad mob wants to buy in March, April, May. They wanted to buy a massive amount of downside protection. Now the mad mob wants to buy a massive amount of upside speculation. Mm-hmm. So the VIX has actually been going up on days in the market. We've been calculating this. It's the highest ratio of up days with the VIX with the market since 99. And what that tells you is that there's just a mad mob of investors that were hiding under their tables in March, April, May, and June, playing video games. And the same crowd is now investing in stocks and trying to buy upside calls. And they're buying so many upside calls that it's distorting the level of volatility. And it's the same thing with what I'm talking about with the IBMs of the world. There's just an amazing amount of companies that yield between 3.5% to 6%. that nobody wants to own because they're slow growth income producing companies. And that's in a world where people should be chasing yield, but we've gone from chasing yield to chasing speculation.
Let's bring up one other asset class, then we'll do rapid fire for our final 6 or 7 questions. Before I get to that, we're 11:52 Eastern time. If you have a hard stop, top of the hour, that will adjust what I'm going to say. Do you have 10 minutes after to 11:10? 12.
Yeah, I can do 5 or 10 after that.
Okay, so let's rock and roll. Real estate. And again, my experience, families that live and breathe real estate, that know their local markets, that are well connected, well capitalized, not over levered. It's very, very geographic centric. And families that really have an edge, sure, I guess that could work. But I have to look at what's getting crushed: hotels, retail, movie theaters. There's a lot, office space. And then I look at the cities, New York, LA, San Francisco. I don't know if they're ever going to be the same. Now, that's a little bit of a strong statement. They've been very adaptive for 100+ years, many of them, and young people want to move there, smart, artistic people. There'll be many dynamics, I think, in the couple of years that will change. But as an investor in the 1 to 3 year period, wow, especially multifamily housing, where some of the controls that are governmental centric in terms of rents coming down or not being able to kick people out, real estate could be very, very tricky unless you really know your stuff.
Yeah, I mean, it's going to be a great place to be invest over the next 3 years. I think you just have to, if you want to put, say, $10 million to work, I think you need to do it in stages, because we really haven't had, and I've been, just talking to a lot of different bankers in our chat and different bankers that I know, some of our family office. We probably work with, in our Bloomberg chat and Bear Chats, probably work with 50 family offices around the world, and talking to those family offices and the banking teams. It feels like, especially in Latin America, New York, a lot of these governments haven't allowed prices to clear. Mm-hmm. And the fact that you've got the hopes of a fiscal deal coming to New York in terms of state and local aid in the United States, that's keeping things up. But the amount of the politicians just haven't done the math. They're really mathematically illiterate group of people, and so they've been doing these lockdowns without any semblance of an understanding of what they're actually, the default cycle they could trigger. And they think that the government's just going to come in and bail them out with a deal. But those bailouts maybe are in the U.S. are coming, but they're definitely not in parts of the emerging markets. So what you're going to see is probably in the third quarter of this year, maybe second quarter, a real clearing price when we reopen and they stop the forbearance deals, and then a lot of real estate has to clear. I think in countries like Panama, I know in particular, I'm seeing places that are 30-40% off, that are incredible properties. And so you're going to be able to step in and buy real estate, and it's going to be I think a great investment. But that's where you just need to work with a professional and get your timing right.
Why don't we do rapid fire, say maybe 30 to 45 second responses on a couple of questions, because I do want to get them in. Why don't we start with, okay, you're recommending and diversified 15-20%. Again, broadly speaking, depends on a situation in commodities. But the one commodity that we haven't spoken about, probably the most famous one to people, would be gold. What percentage should be made up in gold, and how do you think they should invest in it?
I think gold, silver, I can consider them one basket, and I would do it 50. I would do that basket 50-50. I think right now you need, I would say 5% of your assets in gold and silver. Maybe 3 to 5. 5's a little aggressive, but you want to be more conservative. 3 to 5.
I mean, we kind of went over this already, but someone did ask, and it's still a fair question. Are we experiencing hyperinflation in the stock market?
In the stock market, yes, but you just look at the amount of the IWM's never traded 40% above its 200-day moving average, and it did this week. Yeah, this is crazy land.
Has the modern era of stock twits and Reddit made short selling too risky for market neutral funds and or long short hedge funds?
Yeah, that's a classic example of late cycle. We had this with Yahoo chat rooms. It's the same thing, but more concentrated with leverage. So yeah, it's temporarily extinguished the shorts. And that's another reason why we got to be careful on the downside, because in 2007, 8, 9, 10, I wrote about this in my book, but we had short covering rallies that were acted as incredible speed bumps on the way down. Right now, when you take out the shorts, there's no speed bump. So it sets up for a 87 type fall.
Does the money printing without velocity cause consumer inflation?
No, you need velocity, but you get velocity by depositing money in people's bank accounts and by executing fiscal policy that actually is federal. The Lehman years, we were doing monetary policy that was basically going into bank balance sheets. So the banks were repairing their balance sheets through the yield curve. That was deflationary. That's classic. But monetary policy that is actually implemented in fiscal policy creates velocity, and that creates inflation.
How would negative interest rates in the 10-year for an extended period of time affect the way that convexity models work?
Yeah, it forces more money into alternatives. It'll force money into real estate.
Yes.
But in terms of its impact on convexity models in the bond market, I think it just sets up for a horrible risk reward in bonds, because once you go negative, your downside, if something goes wrong, like another COVID or meteor, not a meteor, but some crazy event, war breaks out in part of the world, everybody's in this negative, this horribly convex environment which can change. And convexity, all the convexity means is, you buy something at 100, maybe your upside is 110, but your downside is a lot lower. And that's pretty bad.
Is there a tail risk in the stock market today? And kind of what would potentially be that biggest risk?
Yeah, the biggest risk is too much money in deflation bets, too much money that is in tech, where if you have any type of inflation surprise, that's just going to cause a massive rotation out and potentially a collapse.
And Larry, I've never asked you, I don't think, back in June, and my audience knows I am an advocate, but again, careful, a limited percentage of the portfolio. What's your opinion about Bitcoin?
Well, we just haven't bought into, I think, first of all, there is a much more broad buy-in now than there was in 2017. That's good.
Sure.
PayPal's of the world, different governments.
And Tesla.
Tesla. The funny thing about Tesla is there's only like 3 companies that have executed the Tesla Bitcoin and
MicroStrategy being
MicroStrategy is a brilliant move, and then Overstock. So you don't want to be in the Overstock camp. I don't think, what I mean? It's a sign of it just hasn't gone quite mainstream yet. So I just think with Bitcoin, at the end of the day, it's just not liquid enough. We're going to have multiple 60, 70. We've had 80% drawdowns in the last 3-4 years. 2. You don't want to be in something like that. If you do want to be in something like that, you want to buy the drawdowns because you're going to get them. I don't understand this. People buying Bitcoin today, you're going to get another 50, 60% drawdown. Wait for it.
Yeah, we've had, someone you're probably friends with, Raul Paul, on, and obviously he's a legendary figure, Real Vision, etc. Obviously very much into that trade. Now that was about 6-7 weeks ago. Maybe he's pulled back a little bit. I don't know. But certainly that's been very intriguing. And you mentioned, Stan Druckenmiller before, who hasn't come out and said that he's a big advocate, but is intrigued by it and has, I guess, dabbled a little bit in it. And Paul Tudor Jones probably has been the most prominent. It'll be interesting how that has a chance to play out. My last question, it relates to the tail risk question a little while ago. Do you have any chilling views about the next big risk, even if it means you're recapping some of what you said?
Um,
Chilling was the key word there.
Chilling view would be like if the fiscal relief isn't big enough, we're going to see a massive default cycle in real estate, and that could be pretty deflationary. So
Yes.
we really need the fiscal response to be large, and right now markets are priced for a large fiscal. So the situation in Washington can be very toxic. They're spending time instead of approving President Biden's cabinet members, they're trying to impeach, a Trump, a president that nobody likes right now. So it's just a waste of time. So what I worry about is things in Washington that would kind of screw up the fiscal policy plane, as we saw in 2018. This can happen, 2017, and if that happens now, we're going to go down hard.
All very good points. And Larry, you're amazing. For those that would be interested in your books, in the Bear Trap Report, how could they learn more and interact?
Well, thank you very much, Angela. On Twitter, I'm at ConvertBond, and the book's on Amazon. It's a Colossal Failure of Common Sense. Our website is thebeartrapsreport.com. You can Google Bear Traps Report. And we now have clients in 26 countries in the Bear Traps Report, 90% buy-side institutions. It's not a newsletter. It's more of a research platform that engages family offices and hedge funds through the Bloomberg terminal. And it was great to join you.
Thank you so much, Larry. I do a close. It takes about 90 seconds. So if you're in a rush, it would be okay to exit. So don't worry. It's great to see you. Look forward in about probably 6 more months to have you back. Everyone, okay. I'm Angelo Robles. I'm the host of the Angelo Robles Podcast and founder and CEO at Family Office Association, a global membership organization dedicated to families of great wealth and success and active investors and their family office professionals. We do a significant amount of original proprietary content, host global programming, host many, like well over 150 plus of digital interactive programs for our members and engaged partners to be a part of. We have private forums for families to discuss investing and other opportunities for them, and do many things. Simply go to our website, familyofficeassociation.com. Membership is very easy to find, easy to apply and be a part of. We look forward to certainly your participation in that, and go and subscribe to my most active of my social media platforms. That would be my YouTube channel. Very simply, we're Family Office on YouTube. Everyone, again, I'm Angelo Robles. Thank you so much. And my direct email is angelo@familyofficeassociation.com. My final comment, a reminder, this is opinions at this point in time. Everyone has different time horizons, risk tolerances. It's meant to be educational at the moment per opinion and entertaining. Do your own diligence on any allocation and investing. Everyone have a great day. Thank you.